Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing a company that was actually recommended by Vahid Nazari, where he pretty much just said, "Hi, I kindly appreciate if you analyze ISRG company." So this is what this company is. It is essentially, guys, a company that pretty much uses robots in order to operate on people. So I think this is going to be kind of an interesting company because, well, we are heading more into a technological sphere, especially when it comes to medicine as a whole. So let's analyze this company based on their fundamentals and see if maybe at the current share price it is a fairly decent price to buy it at. So with that said, let's get started with this analysis. Alright guys, we're going to come right into the calculator. Unfortunately, this company does not pay out a dividend, but nonetheless, ticker symbol of ISRG, market cap of $76 billion, PE guys of 54.12. So that's already telling me that at the current share price of a whopping $211.85, this might be a little bit overpriced, right? But PE is only one metric. Let's take a look at other metrics such as cash flow, revenue, and net income, and of course shares outstanding, to see if maybe we can come up with a future value for this company and as to what we should be paying for that growth today. Now, as I said, they do not pay out a dividend, which means that all of their cash flow, their current and 5-year, is going straight into themselves to grow the company. But now guys, let's actually analyze some fundamentals, starting of course with the net income 5 years ago of $670.9 million to 1 year ago guys of $1.7 billion. That is an increase of 154%. And I gotta say, this net income looks really good, right? Consistent growth. We had a little bit of a hiccup here 2 years ago, but COVID happened 2 years ago. So this is a COVID number. I'm essentially going to ignore every single part that I see that has this kind of a dip in the 2 year ago number. If you exclude this, then you can pretty much just see that their trajectory is very consistent. Coming now to the free cash flow, the most important profit metric that we have to analyze, because guys, well, cash flow, it is essentially everything for the company. A company uses cash flow to pay out a dividend, which they don't, but if they would issue cash flow, right? They pay down their debts, they buy back shares, they make acquisitions, and of course they overall grow the company. So it is very important to have this number consistently increasing as well. So 5 years ago of $953.2 million to 1 year ago of $1.7 billion, increase of 82%, with a 5-year average of around $1.2 billion. Guys, this is looking like a really good free cash flow. Again, we see something very similar to that of the net income 2 years ago, where they actually dipped a little bit, but actually it wasn't even that bad of a dip, right? They went from what, $1.172 billion 3 years ago to $1.143 billion 2 years ago. That's not too bad of a dip, right? And the following year they did recover fairly nicely. So this is looking like a really solid free cash flow, guys. Now looking at the revenue, the last of the profit metrics we got 5 years ago of $3.1 billion to 1 year ago of $5.7 billion, a really nice steady increase as well of 82%. That's actually really good. And again, we see a similar thing 2 years ago, where because of COVID they went down from $4.5 billion to around $4.4 billion. So that's not really anything to worry about, guys. As I said, with the net income, ignore pretty much all of these dips that occurred 2 years ago and attribute it to COVID. It was a one-time thing. It probably isn't going to happen again, and it actually did it because 1 year ago they exceeded that by a decent amount. Now moving on to some balance sheet numbers. Total assets minus the total liabilities. Can this company survive a downturn in the economy with their assets, right? Can their assets cover their liabilities? That's essentially what this metric looks at. So currently, guys, this is looking really solid. Again, currently they're at $12.1 billion in this difference. And in addition to that, guys, look at this increase. Talk about us there, bro. Nazari, from what I'm looking at this right now, this is looking like a really good solid company. Oh my god, every single metric that I have analyzed so far has been increasingly really consistently, and the total assets minus the total liabilities is another one. Average total assets, it's around $10.3 billion. Average liabilities is only gets to like $1.4 billion. And doing this difference, guys, we get almost $9 billion in assets minus liabilities. That's actually really solid. But just because assets minus liabilities is a good metric to see if a company is solvent or not, companies, as I said, when we analyze their free cash flow, companies use their cash flow to pay down their debts, not necessarily their assets, right? So we're going to take a look at now cash flow minus the total liabilities to see if maybe their cash flow is exceeding their liabilities. And when I first saw this, I honestly had to double check it because I could not believe this. Guys, take a look at this. Currently, as of 1 year ago, they're actually in the positive for this. Now, for all those of you who may have seen previous videos, you'll know that this is actually very, very rare. Normally you see this in the negatives, which they were in the negatives from 5 years ago to 2 years ago. But what I usually try to find when it comes to this metric is, hey, are they at least getting closer and closer to zero, right? Are they paying down their liabilities, and is their cash flow increasing as well? That would make it closer and closer to zero. Don't expect it to be positive. But guys, look at this. As of 1 year ago, they were positive by $132.4 million. Now, does this mean that they paid off their liabilities? No, what this means is that their cash flow superseded their liabilities, and if they wanted to, they could take their cash flow to pretty much eradicate all of their debts, which is again really, really good. And after doing that, they would still have $132.4 million left. Now, if we take a look, guys, at the average cash flow minus the average liabilities, we get around negative $126 million. Now let's take a look at the metric that I was actually dreading to analyze with this company. So far, we have seen everything gold stamp approval, right? However, shares outstanding, it's usually the one that companies tend to fail, especially companies that don't pay out a dividend. Essentially, guys, shares outstanding, it is how many shares there are out there in the market for you to buy. You want a company to be buying back shares because by default, the shares that you already own already are way more valuable. Now, sad to say, this is the only bad metric that we have seen so far. They are increasing shares, guys. 5 years ago of 336.9 million shares to today of 358.9 million shares. That is an increase on the 5 years, guys, of 6.5%. And from the previous year to the current year, this is looking at 1 year ago, of 357.7 million shares to today of 358.9 million shares. This is an increase of a little bit more than 1/3%. So unfortunately, they are increasing their shares, guys. That's really, really bad. But 6.5%, I normally say, hey, between 0 and 5, that's pretty much like they think that their shares are overpriced and all this stuff. But this might actually be the same scenario that we're looking at right now, right? The PE, guys, is significantly high. So even though 6.5 is way more than I would be comfortable with, it might be that they just feel that their shares are still overpriced and that it should come down a little bit. I think that's the reason why they're issuing shares, but nonetheless, this is still a dilution of your shares nonetheless. And now lastly, when it comes to the cash and equivalents, they currently have $1.1 billion in cash and equivalents with an average cash of around $1.1 billion. Alright guys, now it's time to make some assumptions, low, medium, high, to see if maybe we can figure out what is a good price to pay for this company today based on 3 different assumptions, right? Revenue growth, the predicted share buyback, and of course the required rate of return, which I like to keep flat, guys, at 10% to match the average for the S&P 500. Now, for the revenue growth, guys, let's come over here to Seeking Alpha, and we can see that the revenue growth year over year on this company is around 15.5%, and the revenue growth forward, guys, is 17.13%. So my job as an investor is to be conservative, right? Is to be conservative with my assumptions, because the more a company grows, the harder it is for them to grow, right? The more market share that they get, the harder it is for them to get new market share. So I have to take that into account. Now, when it comes to this company, guys, personally, I think that a low assumption for the revenue growth would be around 10%. For a median assumption, let's say around 13%. And for the high assumption, let's say around 16% revenue growth. A little bit less than that of their revenue growth forward, right? Just so that way we are a little bit more conservative when it comes to these numbers. Now, for that projected share buyback, guys, unfortunately, they are issuing shares. I don't know if they'll continue to issue shares, right? Because 6.5, it's like they might continue it, they might not. But let's just say that they will continue to issue shares. But for all intents and purposes, let us actually say that they will continue to issue shares at a little bit higher of a rate for the lowest assumption of around -7%. Now, for the median assumption, let's say that they'll bring it back down to around -5%, meaning they're still issuing shares, but instead of 7%, they'll issue at 5%. And for the last assumption, for the highest one, let's put in -3%. So guys, with these assumptions, well, we can see that we have some target share prices now. For the low assumption, this puts me at $75.10. For the median assumption, it is $84.53. And for the highest assumption, it is $94.96. Now, while that is all good, let's also analyze this company when it comes to their debt. Because guys, we take the cash and equivalents, which is why we look at it. We also take the net debt and then we add them together. And if a company has more debt than cash, then obviously this number comes down. And if they have more cash and debt, then this number comes up. And as you can see guys, it does come up to around $153.06 for the low assumption, $172 for the median assumption, and $192.90 for the highest assumption. Now adding a margin of safety on top of this guys of 5, 10, and 15%, this puts me between the range of around $130.10 to $145.41. For the median assumption, it is $146.19 to $163.38. And for the highest assumption, we're almost at $164 to $183.25. Guys, the current share price is $211.85. So, looking at these numbers, essentially, for the target share prices, this is pretty much a no-go right now. You would need to wait for this thing to drop a pretty decent amount. However, adjusting for debt, well, we're essentially almost there, guys, at the highest assumption of around $192.90. So, you might be willing to pay a premium, assuming that you believe these assumptions that they'll grow in the next 4 years of 16% and issue shares at -3%. If you believe these assumptions, guys, then you might want to consider buying it at this price based on the target share prices, adjusting for debt. However, this guys is based off of my assumptions that I inputted right here, right? Therefore, I suggest everybody should make their own assumptions, because this isn't financial advice and every investment is the present value of all future cash flow. I am not telling you guys what to buy. I will never tell anybody what to buy. I'm just giving you guys my opinion, right? And all the numbers that we just saw when it came to their graphs and profit metrics, it is all public information. That's why, guys, I have this calculator available for free. Anybody could have it. You can also have my book value calculator when it comes to companies that don't have capital expenditures or companies that are just better to analyze using book value. A re-evaluation calculator, which I actually changed up a lot. I will be making a video on this in the near future, as well as, guys, my dividend tracking sheet for all those of you guys who want to track your dividend paying companies or just want to track your companies in general, right? I'm giving you guys all this for free. All I'm asking for in return is just help me grow my channel. Thank you so much for everybody who have subscribed so far. I really do appreciate it. All I'm asking for is like, subscribe, comment, something in return, something free in return for something free in return, right? All I'm asking for is something free in return for me giving you guys something for free as well. And guys, I also bought a new mic recently. Hopefully you guys could tell within these past videos that it sounds a whole lot clearer. So I'm investing in YouTube as well, because I think that you guys deserve the best quality content from my end. So, I really am working hard on this. I really am trying to give you guys the best possible content as possible. All I'm asking for in return is just to help me grow my channel, like, subscribe, comment, and of course, tell your friends and family to check this channel out if they would like to learn how to invest using a fundamental process. Final thoughts on this company. This is actually really, really good. Oh my god. I gotta say, you just brought me up. I think you brought me a gold mine. I'm not even joking about this. The one issue, right? The one issue that I have is that shares outstanding. Now, they are increasing it. I think it's because, again, their share price is very much overpriced. So I honestly think that they're just issuing it because they think that it is overpriced. If that's the case, guys, get ready, because if this thing falls, which, by the way, guys, they have already fallen a decent amount. In fact, on the 1 year, they have fallen 34.74%, and on the year to date, they're falling 41.15%, with a 52-week range, guys, of $369.69. That is absolutely insane. So I honestly think that the reason why they're issuing shares is because of the fact that they are like, our share price should not be $369 at the peak, right? So let's just issue shares, let's get that money back, and let's do something with that money. I honestly think that's the reason why, and honestly, that's a really good reason to issue shares in my personal opinion. So I think that's the reason why. It is a dilution nonetheless, but it is justifiable. The one other thing that I wish this company did, unfortunately, is that they do not pay out a dividend. But, you know, a company is worth more than a dividend, right? So this actually might be a really, really good company for a growth portfolio. Thank you so much for the recommendation. And that pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech sites. Link in the description below. So with that said, guys, peace out. And I will see you all in the next video.